the 200-day moving average. In April 2025, the S&P 500 crashed to a critical level, the 200-day moving average, and fell all the way to 4850. That is a 31% drop from its high. If you were watching this channel, you knew exactly what that meant. Elevated risk, double the normal volatility, get your house in order. Today, June 2026, S&P is back above 7,300. The 200 moving average sits at 68.95. We are back in a safer zone, above the line. But here's what nobody's talking about right now. Federal Reserve Chair Kevin Warsh, in his first press conference as Fed Chair, just signaled the next move from the Fed might be a rate hike, not a cut, a hike. At the same time, only 56% of S&P 500 stocks are above their own 200-day moving average. The VIX is still sitting at less than 19, right on the doorstep of elevated territory. So we are technically above the critical line, but the conditions around us are flashing yellow. And when you understand the 90-day framework we're about to break down together, you'll know exactly what that means for your portfolio, your risk, and your next move. That is the Black Swan channel. Look at this chart. This tracks the S&P 500, the blue line against its 200-day moving average. The red dashed line from January 24 through the end of 2026. You can see the story of the last 2.5 years laid out right now in front of you. The green shading above, that's when the market was safely above the 200-day moving average. The red shading, that are the danger zones. And you can see it clearly. In April 2025 is a critical moment. Market fell below the 200-day moving average. The red shading lights up. The S&P drops to 4850. That is when our framework said elevated risk volatility nearly doubles. Caution. According to the data from RIA Advisors, that breaks in March 2025 started a period where the 200-day moving average acted as a price resistance on the way back up, just like the framework predicts, just like it always has. Then markets recovered strongly. And here we are today, 73.25, remarkable recovery. But here's the nuance I want you to pay attention to. We are 6.3% above the 200-day moving average. This is not a huge cushion. In the 2022 bear market, markets fell 25% from peak to trough, while technically still close to the 200-day moving average. And there's something else about macro's latest data that should give us pause. Only 56% of S&P 500 individual stocks are trading above their own 200-day moving average. Let me tell you what that matters. The broad index is rising, but only 56% of its members are participating. That's what we call a weak breath. It means a small number of very large stocks, think your mega cap, names are doing most of the heavy lifting. Everybody else is struggling. That is not the foundation of a healthy bull market. That is a market waking and waiting and walking on stilts. Take a look at this chart. This is a VIX chart, right? The VIX is around 19 today. That's technically below 20. That's the blue line that you see across. The threshold we call the fear line. But in the last year, the 52-week range has been 13.4%, 13.4 on the low end, and all the way to 13.35.3 on the high end. A VIX of 35 is panic territory, and we got there within the last 12 months. The VIX doesn't stay low forever. It has what statisticians call mean reversion. It always comes back to historical average. The average is around 17 to 20. We're here on the hedge. And here's a wild card that is new in 2026 that didn't exist in our original analysis. Kevin Warsh, the new Fed chair. In his very first press conference on June 17, Warsh's first meeting at Fed Chair sent shockwaves through the market. He kept the rate unchanged, but the dot plot indicated rate hike coming in 2026. And the Dow fell 500 and the S&P dropped 1.2%. And yield surged. What does that matter for our 200-day moving average framework? Because rising interest rates increase borrowing costs, slow economic growth, put pressure on corporate earnings, and historically they have pushed stock market closer to that critical line. Take a look at this chart, right? Let's zoom out even further because this data reveals something crucial about how to interpret a 200-day moving average break. and it changes everything about how you should respond. Not all 200-day moving average breaks are created equal. The research from IIA investors identified two complete different types of breaks, and their outcomes are almost opposite to each other. Type 1, the sustained break. This is what you saw in 2008 and in 2022. Right? The S&P 500 falls below the 200-day moving average and stays there for months. The moving average itself starts declining. Earnings are falling. The economy is deteriorating. The Fed is fighting inflation or recession. In those sustained break scenarios, the 12-month forward return from the break are deeply negatives. Minus 40% in the dot-com crash. Minus 38% in 2008. Type 2, the brief whipsaw. It is the October 2023 break when the 10-year Treasury yield spiked. The market dropped below 200-day moving average and then snapped right back. Within weeks, it recovered, and the 12-month return from that event plus 27%. And look at what happened in March and April 2025. The S&P broke down the 200-day moving average. It dropped 48.50. Market panicked, and then it recovered. Came roaring back, and today we are at 73.25. So was that a sustained break or a brief whipsaw? Based on the recovery we saw, it looks like a whipsaw category, which historically delivers strong positive returns. But, and this is a critical but, we don't know yet whether June 26 is the beginning of a new leg up or whether the Warsh hike signal and weakening breadth are setting up us for a next test of the 200-day moving average. And that uncertainty, that is exactly what the Black Swan framework is built for, not predicting certainty, but managing uncertainty. So do join this channel, become a member, and subscribe. So what does it all mean, right? We started with a chart that covers nearly 100 years of market history. Simple, elegant truth. Volatility nearly doubles when the S&P 500 trades below its 200-day moving average. That framework didn't just hold through the Great Depression. It held through Black Monday in 1997, through the dot-com crash, through 2008, through COVID. And yet, it held again in April 2025 when the S&P 500 crashed to 4850, below the 200-day moving average. Exactly as the framework predicted. Elevated volatility, dangerous terrain, the need for caution. Now, we are back above the line. But we have a new wild card, Kevin Warsh, signaling that the next move might be a hike, not a cut. We have breadth that is not fully participating. We have a VIX that is hovering at the edge of elevated territory. In the language of our framework, we are in a blue bar, the safe zone. But the orange bar is not far away. And the investors who survive the thrives through what comes next. Whether it's a bull run to 8,000 and a correction back to 6,500, are the one who understand what regime they're in. Knowledge does not eliminate risk, but ignorance guarantees you'll be caught off guard. And basically what I'm saying is that a lot of what we're going to be doing next is going to hover around, take a look at the 200-day moving average, very important, but also look at what Warsh is talking about, but how the market reacts to what he's saying today. I mean, the guy mentioned the fact that, we might not have an inflation problem, and gold shot up. It's all about what Warsh says, what he doesn't say, what he means, and what he does not mean.